Well, Indian markets have been outperforming global peers this year, in a sharp contrast from what we saw last year. And one of the reasons that could be attributed to this underperformance is the relentless selling by the FII community. In fact, FIIs have been net sellers in Indian equities for months at a stretch. According to Bloomberg data, FIIs have pulled out nearly $4 billion from Indian markets so far this year. So where is the money going? Let's take a look at this table. As I said, the Indian markets have seen outflows to the tune of nearly $4 billion so far this year. The money is flowing into these emerging markets. See, Taiwan is appearing to be the hot favorite amongst the FII community because it has seen inflows to the tune of nearly $9 billion so far this year. Next comes South Korea, which has seen an inflow of somewhere around $6.5 billion. Japan, Philippines, Vietnam, Thailand, all of these nations continue to see steady FII inflows. Now, experts believe that it's the valuation gap between India and the emerging market peers that is driving FIIs to other nations. Let's take a look at the valuation picture then. The Nifty one-year forward price to earnings ratio stands at 18.5. Now, this is much more expensive compared to countries like China, where it is a little under 10, and in Brazil, where the PE ratio stands at 7.55. Other nations like South Korea, Taiwan, Thailand are all cheaper in relation to where India is standing at the current juncture. Now, if the valuation gap between India and these emerging markets keep narrowing, that is something that could lure FIIs back into Indian markets. Let us look at what are the factors that could get FIIs back to India. First, sustained earnings growth. Now, corporate earnings have been pretty steady in the quarter gone by despite the gloom that we have seen in the global economy. And even though we have seen a steady correction from record high levels on the Nifty, the price points haven't turned as attractive to lure FIIs back, which is why experts say that sustained earnings growth coupled with an attractive entry point of further sell-off in stocks could lure FIIs back. Let's also talk about a fiscally prudent budget that was announced this time around. The FM has laid out, or in fact has pegged the FY24 fiscal deficit target at 5.9% for the next fiscal. Now, she has also assured that the deficit could reduce to 4.5% by FY25 to FY26. So this should give some confidence to FIIs, given the fact that India is pegged to be one of the fastest growing economies in the world. So aside of these points, let's also take a look at how the Nifty corporate earnings picture stands at the current juncture. If you look at the Nifty EPS for FY23, it stands at 1,023 rupees currently, and it is expected to get better and improve to 1,100 rupees in the next fiscal. So a fall in stock prices coupled with steady earnings growth could persuade FIIs to come back to India. However, experts believe that there are no visible signs of reversal just yet, as the sentiment remains muted and we continue to see outflows on a daily basis. But we could see a reversal in trend sometime in the future.